Hit it.
It's Friday, February 27, 2026, episode 286. I'm Patrick Serezna.
And I'm Kevin Muir. This week we have a real treat for you folks. Trader Ferg checks in to chat about platinum and the other white metals, oil, why he loves the service companies, and make sure you stick around for the whole interview to hear what he bought his dad as a big thank you. I think we can all hope to have kids as kind as Trader Ferg. Then it's time for Talking Charts with Patrick, and man, do we ever need Patrick's and the crayon chewing guru. Markets are that wild.
It is crazy out there. You know, Kev, we might even drink some beers along the way. I don't know what you're drinking, but I've got
middle of the day for me.
This Helles lager. It's from Toronto there, yeah. Let me give it a go. It's a light crisp lager. Let's see. It's gonna do well. This is gonna be a good episode here. Anyway, what's it called? I guess, Kev, we might as well just hit a quick disclaimer and then we can jump to it.
Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. Side effects of too much huddle may include the post-earnings reality repricing, the NVIDIA multiple compression complex, and here's the one that a lot of people are suffering from: sector rotation whiplash.
That's a nasty one. It's ugly out there, bud. It is ugly out there. All right. Anyway, let's get to Trader Ferg.
It's our great pleasure to welcome to the show Fergus Cullen, author of the Trader Ferg Substack. Ferg, thanks for coming on.
Thank you for having me, Kev. It's an absolute pleasure and honor to be here. Honestly, I followed your stuff. Yes.
This is going to be terrific. Thank you. And for those who don't know, Ferg is actually in Bali. So is it late at night for you? What's the time zone change?
Yeah, it's 20 to 8 here. Not too late.
Oh, okay. Yeah. So it's not so bad.
We've got a big gap. Yeah.
Yeah. So we're going to learn how you got to Bali and stuff. But before we get to that, let's hear a little bit about your story. And we were just kind of reminiscing before the show about the fact that we're both from former British colonies. You're from New Zealand, and you grew up as the son of a farmer, and it looked like you were going to actually be a farmer for a little while. Tell me a little bit about your background and, you know, the route it took to where we are now.
Yeah, so I grew up on a sheep and beef farm in New Zealand, about an hour drive away from Wanganui, which is a pretty simple little simple little place in the bottom of the North Island. I went to boarding school, worked on the farm every summer, and thought I was going to be a farmer. I got a rugby scholarship to go to a farmer college in Lincoln, down in Christchurch, and did my first year there before deciding farming wasn't for me. Yeah.
So you're at school doing rugby and farming, and you say that's it. Do you drop out and go explore life and the world, or how does it evolve from there?
So I actually had this I really disliked this one lecturer, and he was lecturing me on farming, and he came in one day and he goes, "Oh, I guess you're not here for the money, because otherwise you wouldn't be doing farming." And then it turned out he was a lecturer because he was a failed goat farmer. And so I was like, I don't know if this is a good idea. And I'd seen Dad, Dad's a super smart man, but God, farming's hard in New Zealand. It was always just like the just getting kicked by whether it was the weather, by the always at the bottom of the food chain, by the supermarkets, by the sort of exporters. It was always tough. And while I was at uni, I got to know another lecturer, and he was heavily into property and finance, and he turned up every day in a Maserati, and he was doing it to give back. And he had this commercial property, and he was telling me how he was getting like 9% yields on his commercial property, and I knew like farming was averaging maybe 3%, and you worked your ass off. So I'm like, I'm gonna jump ship, and that's what I did. Yeah,
it's hilarious. The failed goat farmer scared you off farming, and the Maserati driving professor moved you into commercial finance.
Yeah.
So you worked in commercial finance for a little while. Learning the business and working with him. Is that how it worked out?
So I finished my degree. I got sort of a property finance degree, and
Yeah.
then what still happens to this day, there's this crazy brain drain. You get paid about a third more at least to go to Australia. So I
Oh,
jumped
okay.
the ditch and went straight into asset management in Australia.
Okay, so
And
I didn't realize that because you suffer from the same thing we as Canadians do with Americans, is that we lose like a lot of people to America because you make a lot more money. That also
yeah,
happens in New Zealand.
yeah, 100%. Yeah. So Australia is instantly sort of at least sort of a 30, if not a 50% jump in your salary.
Oh
So
wow!
yeah,
But aren't the cost? But obviously the costs are higher too. But even so, it's still the opportunities are that much more.
New Zealand's just as expensive without the income.
Really?
yeah, yeah, yeah. You'd be surprised. Yeah,
Oh, I didn't realize that. Oh wow.
yeah. It's completely unfortunate. Yeah.
Okay, so you moved to Australia and you're working in commercial real estate, and it's tell us about that. What are you doing, and then what made the move to more market oriented stuff?
Yes, I did well with that. Got a job with Jones Lang LaSalle in asset management, climbed the ladder, and ended up managing like a portfolio of 23 shopping centres. I was like the sort of the regional manager for all their assets, and just hated it. Hated every day of like I was pretty much a glorified debt collector, and yeah, going around like liquidating people's houses to pay their arrears, and it was just I thought everything I thought I wanted, like a corner office and a desk and a team. I had like 13 people. It was just miserable, and so I was trying to work out how to leave. And I'm also an introvert, so it was awful just getting like literally dozens of phone calls and having to manage people. I'm a terrible manager of staff, so that didn't work. And then I was just trying to work out ways to make money, and the sort of found investing made sense. And then I was lucky enough to go to an investment conference, and I saw Brad McFadden speaking, and
Okay.
he has been my mentor to this day, like over a decade later. And he was kind of laying out just like deep contrarian investing in hated sectors, and it instantly clicked with me. I'd seen Dad do it in farming. Like Dad was very smart with like going back to earlier, like the failed goat farmer. Dad was the first one into goats and the first one out. So he was he was quite a contrarian in farming, and so he got into deer first, and then deer boomed, and then got out. So I'd kind of seen that, and I was like, well, I can do this on the global stage and don't have to be constrained to farming. And so from there, I just studied every night, like absorbed everything Brad taught me. He was really kind to take me under his wing, and quit my job by the time I turned 30. And
Okay.
now 39. So been doing it full time I did have a few sort of high net worth people I was managing their money for, struggling to give us some good results, and just left. And my main trick was just low overheads. I had no debt, no spouse, no
Right.
partner, just sort of traveling with a bag, and that was about it.
So one of the things that just kind of made me laugh is that you're talking about being a contrarian, and I sympathize because I am the same way. Like the more somebody tells me how great this is, and the more it's in the headlines, the more nervous I get. And my big thing I'm trying to work on, Ferg, is what I keep telling myself. The market's not always wrong. There's times that it actually agrees with you. Have you found, so first of all, being that contrarian, what has been your experience in terms of, the feelings you get when you're talking about things that nobody wants to talk about, and and you're investing in things that just are hated and things like that. What is it? What is the emotional feelings that you get when that, and why do you think you are drawn to that so much?
I don't know. I often wonder if it's like emotional makeup. Like I don't really mind that much if kind of get the reception of like walking in like carrying roadkill. Like everyone's just like, what is that thing? Why are you touching that? Yeah, like leave it alone. So, but yeah, I honestly I'm most proud of the stuff that I've found that no one else even wants to invest, even when it's working. It's just like, so yeah, I don't know. Maybe I'm just strange. Probably. Yeah.
Okay, so let's talk about some of those things that even when they're working, no one wants to invest in. Why don't you give us an example of something like that you own that even when it works, nobody wants to invest in it?
One that I've been like the guy that's always pitching it and no one really cares is Rhodium for a while now. Like it's just it's kind of a byproduct of PGMs. It's really difficult to get your hands on. You've got to buy this kind of difficult to purchase ETF in South Africa. And
Okay.
I love the story. I've wrote like just a massive breakdown, and I've never heard another person mention it. And it's
Okay, well, let's talk about this then, especially if nobody's going to talk about it. Tell us, first of all, what rhodium's used for, and then give us the investing merits of and how you do it.
Yeah, so rhodium's largely a byproduct of platinum and palladium production. It's about 85% of it comes from South Africa. So you've obviously got a highly like fragile supply, and I'm always drawn to byproduct production because, you know, even as price rises, there's really going to be no supply response. It's kind of a second order effect. So I love that side of it. And it's got I'm a big history buff, and it's got just a history of doing like 10x every decade. And it's done that for 5 cycles. So if you've studied the cycles, you understand that. And then why I was just a massive bull on it was, like you mentioned, I get constant shit for not wanting to jump on the copper trade just because everyone tells me how amazing the copper trade is. And it feels like every time I switch on, like there's a CEO telling how it's the future and it's the only metal you should focus on, and everyone's throwing their coal and their PGM assets out to focus on copper. And whereas I like where if you type rhodium investment into YouTube, you'll just find a few people saying how it's dead because EVs are taking over, because its main use is in catalytic converters and
so it's like palladium it's like palladium and platinum in that it's mainly used in catalytic converters.
It's almost only used like 85%. Yeah.
So someday if we had no more ICE cars, there would be no demand for rhodium.
Yeah, it would die a slow death. And that's pretty much the consensus view, was that along with like the IEA, that EVs will take over, and as mine production rolls over, so will demand for it. So there's no worry there. And the first piece I wrote on it was just pointing out that I figured that was wrong because I saw the hybrids were taking off, and I thought across the developing world, especially, there was going to be far more demand for plug-in hybrids, and if anything, they actually require more rhodium because when you've got a battery and you've got an engine, you've got to swap back and forth between them. And
so why is that? Because I've heard that before, that they take more palladium, platinum, and rhodium for the thing. Why do hybrids take more? I don't understand why they require more.
So you've got to scrub emissions, and you have more emissions at the startup phase. And so when you're swapping back and forward between the battery and the smaller ICE engine, there's more starts, like cold starts. And so it's sort of 5 to 10%. The Chinese have got it they've thrifted it down, but now they've like hit sort of a floor. And then on top of that, you've got really strict pollution control pretty much across all developing markets. It's the one thing that they really do enforce because no one wants smog. And so I think you're actually seeing like a steady increase. You can track what's coming out of China, and it's about 40% plug-in hybrids. They labeled it new energy vehicles, but that was just to cover up for the fact that there were all these plug-in hybrids that were still getting the same subsidies and getting slipped in to the not just straight
even in China. Because I always kind of got this. Exporting, yes.
China's quite heavy towards just straight EVs with the subsidies.
Right.
But where all the growth is, because you've got like a low replacement rate, obviously in Europe and US, because everyone's got a car. But where it gets really interesting is when you're having BYD putting out cars for like 10 grand, 15 grand. Yeah. You've got a lot of first time buyers. So that's where all the growth is. And I see it here in Bali. Like as of 2 years ago, it was all Toyotas. Like the Japanese just had the sort of Asian market cornered. Right. Now, if I go for a coffee in the morning, I'll see probably 3 or 4 BYDs. Yeah. Pull a taxi, I'll get a BYD. And the finance on them is crazy cheap. They often throw in like a tablet and you get 3 years finance for like almost nothing.
It is shocking to me. I was in Grand Cayman a year or two ago, and when I got there, I was staying at a buddy's place, and he's like, I rented a car, and I got there, and they handed me some Chinese car, like a Ching or something. I'm not even sure what it was called. And he's like, oh, you got one of these, and he was all excited about it. And he was telling me how like the Mercedes guy, the Mercedes dealership fellow had given away his Mercedes dealership so he could sell these Chinese cars. And he's like, these things are like half the price. And they were just pure ICE cars. It wasn't even, a battery car. They were just so much cheaper. And you just realize when you go and travel around the world that it's the rest of the world is, taking up those Chinese cars at an alarming rate.
Yeah. Yeah. And there's a huge push for the plug-in hybrids because you have the optionality. If you live somewhere like I do with Bali, you don't know if the power's going to stay on. You've only got your 12 volts, so it takes a long time to charge. You're not going to have the quicker charging. That's just a luxury in more advanced countries with better grids. Right. And so, people are always going to choose that optionality.
Okay, so let's go back to Rhodium. Why? And I take it you also like platinum for the same reason. I did see some of your pieces where you were actually early. You got on it. First of all, do you still like platinum? And then why Rhodium instead of platinum?
So I own both. So I have a decent chunk of my portfolio. So how I structured it was I went sort of 5% physical Rhodium, 5% physical platinum, and then 6% in Valera, because I don't like owning miners because I know, especially one in South Africa, there's a high chance of me getting screwed, and I'm very good at getting screwed in Africa. And so the idea was if I had two thirds of the position in something that would go berserk if South Africa, if Africa bees Africa and nationalize it or does something crazy, right, then I'll hedge myself. So I'll make out like a bandit. Rhodium and platinum will go somewhere silly. And at the moment, it's kind of all working, which is always nice.
Yeah. So why don't we go through those symbols? So first of all, how do we buy? Well, what are you using for the platinum ETF? Are you using like a Sprout one or is it someone else's?
I'm just using, was it PPLT? It's just a physical platinum.
PPLT. Well, that's the Aberdeen one. Okay. And then what about, so that trades in the US, PPLT, Paul, Larry Thomas. What about the Rhodium?
So Rhodium.
Sorry, I keep saying it wrong.
It's only listed in South Africa, and the ticker for that is ETFRHO, and that's really hard to get your hands on. It's a ETF, and it's pretty much the only ETF which is still actively issuing shares. There's an X trackers that you can buy on IB, but that's no longer actively managed. So that's a secondary trading. So it jumps around like a cat in a bag, which is it's still got the Rhodium. It's still audited, but you have to deal with a pretty illiquid market that just jumps all over the place. So the South African way is really, and you can't buy it physically either. I tried to buy a whole lot physically, and they were going to do me for like 15-16% spread on the way in, and they wouldn't let me transfer it between vaults. So I assumed I would have been bent over on the way out, even worse. So I was like, I'm not doing this.
So that's Edward, Thomas, Frank, Robert, Henry, Oscar, and that's on the South African exchange. And I'm looking at like that, it tracks pretty well. Like, yes, it does go above and below NAV, but it looks like it's pretty reasonable. And so that one, you're saying that this thing often 10 times, like if you go look at history?
Like 20 times if you go from the bottom, even 2016 to 2022. If you go bottom to top, it would have been more than 20 times. And so in essence, it's kind of like the same play, but like just a more levered version of platinum. Yeah, it's platinum on steroids. It's palladium on steroids more, because platinum, you've got a more diverse use base. You've got industrial, you've got jewelry, you've got investment demand. This is a pure play on obviously catalytic converters. Yeah.
Okay.
It's kind of,
sorry, go ahead.
I was joking. I kind of get like junior mining type upside without all the dilution and all the stress. Which is what I always aim for. Yeah, try and put a bit of that in the portfolio.
Why don't you own palladium? I just want to understand, because you've chosen platinum. You're right. That has more of a like they use in jewelry and they use in different things. It's more, in my mind, it's more of an actual precious metal, as opposed to a white metal. And but palladium is just a pure white metal. Like, why don't you own that one?
So my view is that rhodium is a leveraged version and scarcer version of palladium.
Yeah.
And also all the projects that are coming on are now palladium rich. So there's part of my whole thesis is really, when you get down to the only projects in the world that have a high split of rhodium are in one little corner of the Bushveld in South Africa. That's it. Once you go outside that, you go to palladium rich, which the rhodium and the platinum drop, particularly the rhodium drops from, like, in the best parts of the Bushveld, it's like 8% split, and you go right down to 2% split in Russia with no nickel, and in Zimbabwe. So they've got very low rhodium. And then with Russia, it's also a byproduct of the nickel production. So it's a complete secondary thought. So yeah, that's another few reasons why I love it. And the only large projects coming on with no nickel in the future, and that they've got TOF 3, and that's due to come on like 2029, and that would add 7-8% to global PGM production, but then that's very palladium heavy. So that's the only one that I can see that has will make a sort of a meaningful impact, and that wouldn't impact my platinum, or especially wouldn't impact my rhodium thesis.
Got it. And then you mentioned a company. What was the company that you mentioned?
Valera. So this is.
So how do I spell that? Because I'm not familiar with it at all. Valera.
Yeah, VALTERA. Yeah.
Yeah. Well, there it is. Okay, VALS on Johannesburg. VAL. And why this one? And give us the, oh my goodness, this thing's doing great. You're having quite a day. Give us the investment thesis for this, and what you think it might do.
So this kind of folds in my whole strategy. Is I like talking to roadkill. I often buy stuff that's come out of bankruptcy, or stuff that's been flipped out by majors that they don't like. And so this was a case of Anglo. First, they dumped their thermal coal assets, so they got rid of Fungella, which went on to 10 bags soon after they got rid of it, and then they got rid of what was Amplats, Anglo American Platinum, and then they renamed themselves Valera, and they dumped that. And it was one of the early things Brad taught me, is like, pay close attention when a company's getting rid of assets to focus on something else. Generally, the assets that they get rid of go on to outperform in a big way. And so they just happened to sort of flip this out when I built up a lot of conviction in the whole underlying PGM space, which is, PGMs isn't like, I always get asked on like silver, and I'm just a guy like in Bali walking my dog on the beach, and I've got no real research. And so with PGMs, I was like, if I can listen to the earnings for the three main companies, I pretty much cover the majority of the PGM sector. Like if you just follow Valera, Sibanye, and Impala, you've got most of the sector covered. You just have to know what their guidance is. Were they laying people off? Were they what production issues are they having? It looked like to me all their costs were going up. You see all their mine life is all rolling off a cliff, apart from Valera. Sibanye and Impala both about halfway through their reserves by sort of in the next sort of 5 to 10 years. Yeah. And so the setup just looks fantastic to me.
Awesome. Okay, so let's we mentioned China. Why don't you tell me what you're doing in China and where you're looking for opportunities there?
Sure. So I've got a thesis that China, like we are steering at the start of sort of an Asian boom, and it's going to be based around the fact that China, I think, is I love Craig Tyndall, he had this observation that the West has been sort of financializing deficits, while China's been sort of industrializing its surpluses. And I think they stand to massively benefit from this, for the next like decade or two at least. And a lot of people just haven't really clued onto this. Like, there's so many tailwinds for them. Like, they pretty much control the entire processing of the vast majority of critical sort of materials, like right down from like rare earths. Everyone's very aware of that, but all the sort of boring stuff, like they have the majority of processing for stuff like tin, copper, aluminium, and they have massive amounts of energy. So they have been just installing at a crazy rate. They pretty much add like a Germany every year. And a lot of people aren't understanding that when they sort of compare, like Germany's comparison to China's kind of interesting, because they both talk about like adding capacity, but Germany can't use its capacity because it's just adding wind and solar and shutting down all its coal plants. China is adding coal plants at the same time, hand over fist, and just running them at a low utilization. So when it needs the energy, it can just dial them up. So it has this flexibility in its grid that makes me hugely bullish on its ability to scale its AI, for example. If it needs that energy, it's just all there. Whereas with the US, you've seen it just hit the wall with there's insufficient sort of grid investment. There's not enough transformers. And like those sort of examples where we've got all these bullish projections in the US, but China's kind of got the US by the balls, because if they want to ramp the grid, then China controls the transformers. And you got these long waiting lines, and China's pretty much dominated the electrical grain orientated steel. They've got 70% of that market. So they like they
Is
can
that
just,
true? I didn't realize that.
Yeah. They've got 50% of grain oriented steel and 70% of non-grain orientated steel. There's only one company in the US that makes it, and it's like way behind. And so there's all these little pinch points, kind of call them, where you like, it's not a complete monopoly, but China owns like 2/3 of it, and it can just kind of slow drip it so that there can never be sort of a almost like a blockade type headline. But you just watch the wait times go out and out and out. And whereas if you're aligned with China, then you get it quickly. And yeah, I think Craig Tyndall's done some great work on this, that he said it's just like almost like a sort of a bureaucracy admin loop. Like you just get stuck in waiting for your license. Yeah.
But you know what's funny about, as you tell that story, it's almost the exact opposite story that you hear, Wall Street talking about, in terms of, the US has got all the cards and they're the ones that are going to control all this. And you're sitting there and you're saying the opposite. First of all, what's the kind of response when you say that? And, what would be their pushback to the US bulls that think that China is about to shit the bed?
Well, a lot of it is, the debt's unmanageable. They're going to have a sort of collapse, like the whole coal bass kind of take. And I was in that camp originally. I've got Lewis Vincent Garve a lot to thank for showing me the light and showing me how it.
I'm the same way. Louis, I have so much to thank Louis for. Apart from being a terrific person, he's also the one who taught me a lot of these different things. Yeah.
So no, he's been absolutely invaluable. Between him and Luke Groman, like mashing their views together, it's just so valuable, particularly at this point where we find ourselves. So I think he sort of got me over the a lot of my sort of just bearish like rhetoric, and also helped me see that there was I think there's just a lot of Western narratives that aren't really supported, like the whole good luck buying anything in China, you'll get rug pulled, similar to Russia, whereas Russia was like 2% of S&P companies were in some way sort of had relationships and were integrated with Russia, whereas with China it's like 46. So it's like mutual assured destruction if you go down that road. Like it's I've got this one fantastic chart that's I'll email it to you after. I put it in one of my Ferg's finds, so a few people know it, but there's on one side it's like the consolidation of the whole US defense base. So it's like going from like maybe like 50 companies all into just the big like Raytheon and just like 5 companies. And then on the other side of the chart, it's them outsourcing all their manufacturing base to China. It's like you literally can't be more stupid when you do that with your like military, like industrial base.
Yeah.
And this great quote from I think it was a Raytheon CEO. He's like, we can de-risk, but we can't decouple from Chinese. And so there was a journalist that asked, he was like, so if we go to war with China, winning will depend on if they'll supply us.
You know, the part that I loved best was because I think if you remember back like a year and a half ago, the China is uninvestable crowd was huge. Like, and if you go look at the EEM versus the EEM ex China, you see the money coming out of the EEM because there was China in there, and the money going into the EEM ex China was just huge. Like it was monstrous. And Louis' point, you'd always say to people, you know, you'd be out talking to, you know, investors, and they would be telling him how China is uninvestable. And he says, listen, okay, great. I understand you're worried about China investing, you know, China invading Taiwan. And he said things like, he would be like, I don't think that's going to happen, but let's just say you're right. Like, you know, can I ask you, do you own NVIDIA? And they're like, oh yeah, this is our number one holding. He's like, what do you think happens to NVIDIA if China invades Taiwan? And the kind of the paradox of them at the one hand saying that China was uninvestable, and at the same time saying that because of, you know, the risk of them invading Taiwan, and then being fully loaded in NVIDIA was just unbelievable. Like it's kind of shocking to me the markets can be so dumb at times.
Yeah, well, I've often observed that with like there's this assumption that cyclical things have stopped being cyclical. Like semiconductors are no longer cyclical; they're linear or exponential to the upside. And energy, or particularly oil, which is cyclical as well, is now it's staying down. It's not moving. And so there's 2 cyclical assets which have stopped being cyclical. And I just always find that kind of hilarious.
Okay, so you brought up oil. That is one of your big calls right now. So why don't you walk us through your energy thoughts and how you're playing it?
Yeah, so I just think a lot of the outlook on oil has just been so wrong. With a lot of the kind of forecasts have been hijacked by the whole net zero sort of ideology or religion or whatever you want to call it, cult. And the fact that the IEA had to literally get forced to put back in like the current trajectory in its recent policy is just crazy. And when you look at what they keep forecasting and what keeps happening, they have this missing barrels, which every year they underestimate. The missing barrels, they can't find it. All it is developing markets increasing their energy demand, and then they revise it a year or 2, often 3 later, and they just sneak it back in. And they've done this for, I think it's 17 out of 19 years. They've underestimated. And
the
yet
demand, we're talking about the demand side
consumption. Yeah. And I think it's just one of the most chronic sort of appreciated that they just keep doing it, and we keep swallowing that EVs will take over the world, and also forecasting kind of China's uptake of renewables, which is another thing. Like what China does, I don't think can be extrapolated to the rest of the world, because they're doing it from a energy security standpoint. I don't think it would. I think it can be extrapolated across the rest of sort of emerging markets, and then you've got just sheer underinvestment across the whole energy space. You've ever since 2014, and it was topped off by sort of COVID. There's just been massive underinvestment, and also the shale boom has pretty much added, I believe it's 90 to 95% of all additional barrels were brought on the last decade. And anyone that's looked at shale knows it's got a pretty nasty decline rate on the backside of it. And so I've just looking at valuations, looking at how much pain has been in the sector, how much a lot of this is consolidated. Like I've 2 sectors I really love are the oil drillers, and just seen bankruptcy after bankruptcy and acquisition, sort of consolidation after consolidation. And also in seismic, like 70% of that space just disappeared essentially. And so, yeah, you've only got a handful of names, and then you've got to try and survive till the things that inflects. And I think we inflected on Liberation Day, and it's been fun since then. It was pretty brutal for a year before that.
You think it's Liberation Day, it's an inflection. Okay, so let's. I just want to unpack this like one by one. Let's just start with China.
Mm-hmm.
One of the arguments, if I understand you correctly, is that the oil bears will say, look, China is an example of what's going to happen in the rest of the world because they're not using as much oil as in the past, and they're increasingly doing electrical. But your argument is that is actually because China can't import enough oil, and that they are forced to do that, and that's not going to be a model for as the rest of the world grows, as India grows, as Africa grows, and all these other emerging markets. Is that, if I got that correct?
Yeah. Correct. And you've seen it in the data. Like even this glut is slowly kind of falling apart, and the consumption keeps kind of surprising to the upside. And I think it'll do it for, I think even the current scenario of sort of 112, I think we'll probably, IEA's got that for 2050. I think we'll hit that by 2030. Like easy. Yeah.
And like, I think my buddy Rupert Mitchell was the one who, told me, like, he says, like, think about Africa. They're not going to go and be able to, put in electrical carts. Like, there's no infrastructure, and there's no, ability to do that. We are going to be fossil fuel for longer than the market expects. Okay. So that's that side. So then the other thing you mentioned is that the lack of kind of investment capex in oil for the last decade, and I would agree, and I would say that this is a story that you could do for a lot of commodities and not just oil.
Yeah,
but I think with oil, to me at least, it feels like it's a little later in that copper. We haven't made a copper mine in a long time, but oil we were still doing and making shale in 2016 or whatever it is, right? So it's just like, it feels to me like oil is the last of the commodities to really understand that. Would you agree with that?
Yeah, I would. I'd say oil will be one of the last to run, which is fine. I think having having a view on something. Like often when I enter an investment, my time frame is usually 3 to 5 years, so I'm not really too worried if I'm wrong for a year or two. And sorry, I forgot to say on the consumption side, the best way I love to frame it is we in the West, if you just include like sort of OECD, we consume like about 12 barrels per person per year.
Yeah.
If you take the whole sort of developing world, they're sort of free-ish, and so. And all that needs to happen is for them to increase their standard of living, not to get to R12, but just to get to 4, and you add 50% to the entire system. And also they're still growing demographically, so they're set to add another 2 billion people by 2040, 2050. And if you just keep status quo, just add that 3 barrels per person to that extra 2 billion, then you add 50% to the system. And so you just understand that the forecasts are all wrong unless something really bad happens to the demographics, or we manage to keep all those people at 3 barrels, which should be pretty sad for humanity. I know a few people that are like, have some pretty Malthusian outlooks, but I don't hold that.
Me as a Canadian, I always compare it to the hockey stick. And I talk about the fact, if you look at Japan post World War II, you'll see that they started to grow, and and bit by bit their energy per capita went up, and it went up slowly at first, and then it hits a certain level of wealth, and then it just takes off. And it was, you look at Japan, then you look at Korea, and to me, I think we're at that stage for a lot of different other countries. And then one of the things that Rupert Mitchell taught me is that if you go and make cars much cheaper, which is what China's done, you've also helped on the supply side. So now all of a sudden, instead of a car costing you 20 grand or 15 grand, you're buying like $5,000 cars from China, like crappy little cars. It makes it so you can actually afford a car earlier than in the past. Okay, so we're on the same page there in terms of oil. Why not just go buy oil? Like why go buy the drillers and the things like? Give us the reasoning behind that.
I just believe there's an awful lot more torque because the replacement cost for some of these assets is just going to be is so difficult. Take like pretty much my favorite assets is some of the drill ship owners, and a drill ship costs about $1 billion to build. At the moment, there's none in the order book, and if you want to build one today, you're gonna have to wait 5 years. If you could even get one in the queue, because I've sent so many shipyards into trouble and bankrupt, and the day rates are nowhere near what would be needed to even incentivize one.
Okay.
And so you've got this kind of sort of a replacement cost moat, if you will, that once day rates get there, and I believe they will, a lot of the lowest cost barrels are now in offshore, and it just hasn't been touched because we've had shale, we've had quick paybacks, and so whereas the economics were kind of almost on par with shale, like why would you take a super long payback with long cycle capex when you can get it with short cycle? But now that shale's stalling out, long cycle's back on the table, and drill rigs have been cut in half the last sort of since 2018. The last half the drill rigs have been fully scrapped, and so the fleet's been cut in half. And I think those assets are going to print money from sort of late next year, and then you'll have sort of a 5-year runway. And
okay, so explain to me as a novice what you say drill ships. So these are ships that go out and do the actual exploration. They're the ones like in essence, poking holes in the ground.
No, they're the first ones to start pulling up oil in deep offshore. So you've got drill ships, you've got semi-subs, which each of these can go further out into deeper water.
Okay.
And then you've got, you've heard like jackups, they're more shallow, and then you're onshore. And so each of these, you're going further out. You've got more, can go deeper, and there's more capital. They get progressively more expensive. For drill ships, the latest version, there's only actually 2 of them in the world, Generation 8, that are with Transocean, and so they're very rare. Like with drill ships, you're only talking, there's like 92 in the world now.
Okay.
It's a very consolidated little market.
And they haven't made one in ages? Is that what you're saying? Like they just don't make these things anymore?
Yeah, there was a few sitting in shipyards that have been left because there's still some cold stacked, and one by one they're getting scrapped. And
okay.
Yeah, it's
you mean
slowly
cold stacked, meaning not on the ocean. They're just sitting.
not on the ocean.
Okay.
Yeah.
And it's almost like uranium situation where you have an extra supply and you have to chug through all the extra supply before. Okay. So and I interrupted you, but they're getting kind of scrubbed or whatever. Are they, because they're not on the ocean, they eventually they can't be put on the ocean?
Well, the reactivation costs keep climbing, and so there's a point at which the economics just don't stack up. And I've seen some scrapped that really surprised me. They're sort of built in 2012s, and I think it was even 2013, 14 scrapped. So these are really new rigs that were never put to work, and all that just continues to tighten supply. As I say, once see utilization getting maxed out, and there's still 6 that are cold stacked that have to be reactivated or scrapped. And then once you hit that point, and then there's no more supply, no matter, and then day rates become the variable, and that's where,
so we're almost so we're at 6. What were we like 2 years ago?
would have been like 12. I think it would have been 2. Yeah, it would have been more than double. Yeah.
Okay, so we're slowly getting there. Okay, so what are the stocks that we're looking at in terms of like, what is this, the Valaris and like in the rig?
So Valera's just is in the process of getting acquired by Transocean.
Okay.
So that's the big news recently, that Transocean was the only one that managed to avoid bankruptcy, and they are now going to acquire Valaris, and that gives them massive control of the drill rig market, and they also consolidate all the cold stack rigs. So it puts them in a really strong position. It's almost a what do you call it, like a triopoly? Is it just three
Okay.
main
And are they
operators
the
in
biggest
some
ones? So in
areas?
essence, is this the Cameco of the Cameco in
Yeah,
terms of uranium? Okay. So
by a
now is
mile.
this what you own, or is this do you go and play some of the smaller ones with assets?
So I didn't own Transocean, but I'm happy to become a shareholder via them acquiring Valaris. Yeah, I'm
Oh,
quite
I see.
because
So you're
they had a
Valera.
lot of they had a lot of debt, and so we got a nice big takeout margin with their acquisition, and with them with their high debt, and Valaris with its because it went bankrupt, it comes in with almost no debt. So the mixture is a lot more appealing to me. So yeah, I'm a
And are they
happy
paid in shares or
shareholder.
cash?
They're paid in shares.
Okay, so you're
Yeah.
you're just gonna roll it into rig,
Mhm.
and to you that will be your new play.
Yep,
Like
that's maximum position size, and I intend to hold that for probably a
3 to
decade.
5 years.
Yeah, or until it does something stupid, and I see something else hated that I want to roll the money into. Yeah.
Oh, that's funny. All right. Is there anything else you wanted to add about energy?
Not really, other than I think everyone should pull up the chart of XCS, like the equal weighted oil services, and just look at it compared to oil. I think that's one of the most fascinating things. They used to be tied at the hip, and ever since Liberation Day, even with oil going down, XCS has just been on a tear. And that's always when I see every time I've seen sort of the fundamentals diverge, I know I've got to kind of like lean into it. Yeah.
In terms of the oil services are beating everything else. So you're like,
Yeah.
that's giving you optimism about your trade.
Yeah, and I usually hang out. So a lot of my portfolio was in small Asian oil services. So I have kept entertaining myself by chasing around like 50 million sort of market cap Asian oil services, and I come unstuck occasionally, but got taken out of a number of them, like just sort of acquired for a little premium. I've got one that's become my biggest position because it went bankrupt twice, and then I picked it up, and now it's gone on a tear.
Good for
So
you.
yeah,
That's a good problem to have.
that's kind of
When your
keeps me
stocks
entertained.
rally so much they become your largest position because they rally in such a big way. That's a good problem to have. Okay, so we're nearing the end here, or getting closer to the end. What question I should have asked you that I didn't? Like what's on your mind? And like if you were doing the interview on yourself, what would you have asked yourself about?
Well, so I've recently been trying to invest my parents' money, and the first thing my parents kind of said was like, "Don't invest in your like shitty companies." And so I've become really fascinated with global exchanges, and so
Oh
they
yes,
are
yes.
a very high quality business. So this is exchange operators that are kind of hated, and the main reason for this is just you've been fighting like a crazy currency headwind. So in a lot of these exchanges, the currencies have lost sort of 50 to 80% over the last decade, and you didn't get the flows. Like if you think of a sort of an emerging exchange operator as like almost a toll road, they were just getting no liquidity, no traffic, and so the performance has been really underwhelming. And I just see that changing. I'm like a huge bull on emerging markets, and for anyone that's studied the history of these exchange operators, they almost invariably outperform their underlying index, and often by a really large margin.
Yeah.
So you've got some that are just complete multi-baggers, whereas the underlying index did okay. And even if you completely stuff it up, like one of my favorite examples, if you bought the Athens exchange, you still, I think you came out with sort of 110% return, whereas you got absolutely dusted in the Greek index. You came out with a 20-year return of minus 5% or something.
And
And
yet the
so
exchange, it's almost like in the old days, they used to say a lot of the kind of when people were playing emerging markets, they would go buy the banks. They would go, just buy the bank, right? And you got a new take on this. Like instead of buying the bank, it's buy the exchange. And by exchange, we mean like stock exchange or some sort of toll, as you mentioned, a toll booth operator that trades in the financial assets of that country.
Yeah, and there's only a handful of them because quite a few are state owned. You can't trade them. Some of the ones that I'd love to get my hands on, yeah, they're not publicly listed. So there's only really a handful. They've got great dividends. Like I've put together a basket for mum and dad, and that spits out nearly 5% dividend yield. They they they're really interesting. I'm a big sort of inflation bull, and so I think
Yeah.
inflation's going to really kick off, and I kind of want to protect their income. This is what they're going to live off, and so the exchange operators have got a really interesting business model, and they actually benefit from inflation. They're capital light. They have a moat. It's really hard to disrupt, and inflation generally causes more trading, and so they actually have higher volumes during inflationary periods and do really well. Whereas like a miner or something might see its margins get squeezed, so people get all excited about their miners, and then something like energy runs and squeezes the margins and makes your returns a lot worse. Whereas you don't have that problem with exchanges, and they almost benefit from volatility. Like you actually see volumes go up during really crazy volatile times. Like there's some good studies of exchange volumes during the GFC. And so, yeah, the only thing you've really got to get right with them is the currency. And I'm a big dollar bear for the next decade. I always love, I kind of arrived at it. I made a sort of emerging market basket of all the exchanges buying and worked out how much they'd lost over the last like 15 years. And the average was 80%. And then the next day I was reading Luke Roman's piece, and he just looked at a few different items made in Asia and then made in the US. And he was like, the US dollar needs to depreciate roughly 80% for it to be equal. And I was like, yeah. So
There's good old Luke. He's taken a very staid response to how much the US dollar has to go down.
yeah.
So a couple of things. First of all, I have a good buddy that he likes Brazil, and he says, stop thinking about all what you're going to buy in Brazil. Just go buy the exchange. Is that one of the ones that you like?
Yeah, I love that. Absolutely.
What is it?
Love-
BR3 or something? What is it? Like
B3 SA. Yeah.
Oh, B3, that's it. Yeah.
It's a beast. It's like I'm pretty sure it's sitting on a forward dividend yield of 6%. It's gobbled up a whole lot of its competitors over the last sort of 5 years. Yeah. Yeah. No, I think that's a beautiful play on sort of South America.
Listen, I think that's a genius idea in terms of exchanges. And when you were going through the positives of it, it was like, oh, yeah, that makes sense. And when you're thinking about the environment we're approaching, where the volatility very much might go up and the dollar might go down, you're absolutely right. This is a terrific idea and a terrific way to protect yourself. But before you go, you mentioned two big, huge macro things there you have views on. So we got to talk about those. Inflation. Let's start with inflation. Why are you such an inflation bull?
Well, I just see it as the only way the US has out. They have to sort of print their way out of this. The math doesn't math. And yeah, I just see them having to sort of print their way out of the debt. They can choose to default. They're not going to do that when they can print. Doge showed how the sort of austerity road went.
Yeah,
it didn't work. And so yeah, we know what the end game is. And so yeah, I want to stay away from US assets. It's also interesting there that the like coming back to the comparison between US and China. There's a lot of the US's service-based economy, and there's like there's a lot of obviously great protection of IP and software as a business. I always observed with China, they're all like AI pirates. Like they were all busy pirating from the early days. They were, I think there was some story like they were huge users of Microsoft, but none of them paid for it. Like 1% paid right through the 90s, and so they never really respected sort of IP rights to software. And as a result, a lot of the companies just like include it as sort of a value add. Like my favorite examples, BYD just thrown in self-driving for free, whereas Tesla was trying to charge $8,000 for its self-driving. And I think that just sets up the Chinese companies so much more competitively, whereas AI is going to be eating all these software margins in the US. Or I think there's been sort of a fever pitch of how much it'll take over, which I don't believe. I think it's going to hit sort of more physical constraints before that becomes a big issue. But overall, I think there's going to be a big rebalancing. I think they're going to have to run it hot and inflate away a lot of their debt, and the US dollar is going to be the blow-off valve. So I don't want to. I ideally like to avoid the US dollar.
Okay, got it. I can't disagree with any of that. What keeps you up at night? Like, what's your biggest worry in terms of markets?
Biggest worry would be sort of a real correlation type 1 event, like just everything getting dusted, like sort of the old Mike Green, like sort of passive goes no bid and tanks the market.
Right.
I been trying to buy long dated out of the money puts, but I'm a cheap bastard and I want vol cheap and I can't get it. So I have a small position, but I always I'm trying to get record low vol and I can't get it, and so I raise a bit of cash and then and then I.
So you are looking though, like it makes you nervous enough that you're going out and buying some tail hedges.
Yeah.
Well, is that new?
Yeah. I never buy puts. I always lose money when I buy puts. Yeah. I'm the worst shorter I've pretty much just always sent them to heaven. Yeah. Yeah. I even have it written. I had it written somewhere like, don't short. I don't do it. Like, you'll just lose money and then you'll get angry because I could have put the money in some little 50 million market cap Asian play and watch it run for the next 5 years. Yeah.
So what makes you nervous enough to go out and buy puts this time?
I just see a whole lot of stuff that doesn't make sense. Like, take NVIDIA, like it's I just don't understand where like the average analyst estimate thinks it's going to double its sales by 2028. Like, they've got to add 20 billion a month, and I see them already doing these kind of like finance circle jerks, and they're getting the runaround with trying to get their the H200s into China. Like, China's just messing them around. They've been like, we might approve it next week, and then a month or two's gone by and they haven't approved any at all. And the ones they did approve for a few names, they didn't order any. The Chinese government tapped them on the back and said, no, don't order them. So I just don't think it ends badly. Granted, timing on that sort of stuff is nearly impossible, but I get the feeling at some stage the likes of NVIDIA and Tesla, I've been a Tesla bear for a long time, but I don't think it's gonna. And the whole stock price being held up on robots when 70% of their robotic chains in China. I think that's a bug looking for a windshield. And so the problem is, every time I look at it, like I go into the long dated options and I almost want to sell them because they're so expensive. Like there's almost no asymmetry at all. Like you literally buy at the money for leaps, and all you stand to make is like 1 times your money. If it goes bankrupt, it's like, what am I?
It is difficult. Yeah, the shorting is hard, no doubt. Okay, so listen, we unfortunately have to call it a day, but before we do, we're going to do a couple things. First of all, we're going to do a story that you're going to share, someone that was kind to you during your career, and it was important to you, and if you could just kind of share that story.
Yeah, certainly. So the person that comes to mind, I've written a whole sort of post or a Twitter thread on this, actually, was my dad. And I've always really admired my dad for his sort of mental flexibility, because he loved farming and he wanted me to be a farmer. And he was sort of busy trying to expand the farm and set it up for me. And so when I told him that I no longer wanted to be a farmer, I wanted to get into property, I thought I'd get some pushback and he'd try and talk me out of it and say, like, no, look, I've spent my whole life doing this. I can teach you a lot. I can give you a lot of value. But instead he said, what do you want to do? And I said, I want to do property. So he went out and bought a whole lot of books and got really into property. We started discussing it every week. He bought his first property within a few months, started shifting money from sort of the farm, and eventually built up a whole commercial property. We discuss it the whole time, discuss deals. And then that continued right through my kind of property career. And then when I lost interest in property and got into investments, he started wanting to go to investment conferences. So we'd go into investment conferences together, and he got like deeply into investing. And to this day, we always discuss everything. He's my kind of joke. I've got like AI on one side, and I've got Dad reading papers in the local library, sending me articles, screenshots of articles constantly on the other side. And so, yeah, my dad's like just mental flexibility and just always kind of just encouraging me, not judging me, even though, I'd made some pretty questionable calls, like leaving the corporate job when I'd kind of set everything up and then just walking away at 30 seemed pretty silly.
He sounds like a wonderful person, and you're very lucky to have him. And he's lucky to have you because I read a story that you wrote about the fact that he had to sell one of his beloved cars when he was young, and you made it up for him. Why don't you tell us that, kind of share us that anecdote?
Yeah, so he was a rally driver. He did really well in New Zealand rallies early in his career. And then when he had me, it was when all the subsidies were getting taken off in New Zealand. It was really hard times for farmers. Like they went for a period where they had like 20% interest rates, and a lot of farmers were getting pretty much sold up. And so he had to sell his race car, pretty much give up all racing just to survive. And I always knew he loved racing, and since he's retired and moved to Australia, there's it's like Targa races around Australia, and he's always loved V8s. So I bought him a C63 AMG Mercedes, and he's been racing that, and he's just entering another race at the moment. And every photo I get's a massive ear to ear smile. So it's the best return on investment I've ever had.
You're a good son for that. All right. So for those who want to learn more about you, your dad, and all your terrific stock picks, where do they go?
I just traded Ferg on Substack. Yeah, I pretty much, that's the only place I really am now. I gave up on Twitter a while ago. I just pretty much write about what I'm doing with my portfolio, what I'm seeing, and I send out a free weekly email about the best article, podcast, quote, chart, and whatever I'm pondering.
So you said that one's a free one, so everyone can sign up for a free one. So if you want to get his free one, you sign up on Trader Ferg, and then if you want your paid ones, there's different tiers, and you can also do it at the same time there. So it's all at Trader Ferg on Substack, and it's Ferg, Ferg. Ferg, thank you very much for this. It's been wonderful getting to know you, and I love all your picks, and hopefully we'll have you on again in the coming years.
Well, this is a real honor, Kev. Honestly, I've been reading you for been part of a decade. Yeah, like your old macro tourist blog was my first trading blog I started following. Yeah, so
it's very kind of you to say.
This is a big honor for me.
So I look forward to meeting you someday and drinking some beers. And you know what? The fact that you're in Bali makes it all seem much more like you're the kind of guest that I want to come visit in person.
Come to Bali. Yeah, no, we've got a good little neighborhood. A few too many people found it lately, but yeah, it's a fantastic little.
All right, folks, go to Trader Ferg on Substack. Thanks a lot, Ferg. Take care. All right, Patrick, talking charts, lots going on. Actually, way more than people might realize. Like if you went and pulled up the index, you might say nothing's going on, but the reality is under the covers, crazy stuff's happening.
Absolutely. So I have a chart of the S&P 500, and literally it's flat on the year. But I want to do a shout out for Bespoke on their Twitter. They put a dispersion chart to actually show like what's going on in the actual S&P 500, and it was insane. At least if I'm going from memory here, but it was even though the S&P 500 is virtually unchanged on the year, of the 500 stocks, only 100 of them are within a 5% band from where they start at the beginning of the year. So only 20% of stocks. That means 80% had a greater than a 5% move. And what's crazy is 25%, 124 of the stocks in the S&P 500 have made greater than 20% moves, either higher or lower. So it's irrespective. It's just a volatility thing. And so we have underneath the hood, this market is going wild, and the S&P, not a pulse. Like it's not in there, and that is actually the story of sector rotation. And we're gonna sector rotation whiplash, as we warned everyone
Yeah.
about earlier, in there. But first of all, do you want to comment on
Well,
that dispersion?
Well, no, I actually wrote a full piece about it. And if anyone's interested, you just email me, kevin@themacrotourist.com, and I'll pass it on. And it was all about this. And you're right about bespoke. You got the data right. There's a million things like this when you look at, like, for example, the Goldman Sachs theme baskets versus the index. We've never seen this sort of volatility. There was also something Charlie McGilligan from Nomura was highlighting in terms of the average S&P move versus the index move. I went and did some math, and I actually went and looked at the high-low range of the S&P 500. We are at levels, Patrick, that we haven't seen since Volmageddon, since that period when it was super, super quiet. And what's amazing is that we have this super, concentrated market in terms of the index and not moving very much. And yet on the other side, just stocks are going one way or the other. And it all has to do with the low correlation. Lots, it's almost, it's a complicated subject. And a lot of people are going to just say that's too much math. But the reality is that, in my opinion, it is showing that there is a lot of crazy things happening that are very dangerous that are occurring under the covers.
And it's funny, exactly to your point. There's so many people that comment online on these things. It's like, oh, the S&P's 1% from its highs. You guys are just being alarmists or whatever. Like, there's all these kind of comments. I don't mean to be that cynical, but like, the point is that a lot of people are doing this. They're just looking at the price of the actual S&P, and they're using that as the gauge, is that is the accurate kind of depiction of what is going on. But what we really have under the surface is that violent sector rotation. So let's start with the bullish side. Like, let's not get into bear porn right off the bat. Okay. Let's
work our way up to the porn.
Well, exactly. Like, let's just slowly turn the temperature up here on this, and let's start off with what has been very positive. First of all, one thing that I've often used as alarm bells is when the breadth of the market is deteriorating. And because of that sector rotation, the breadth of the market has actually held up very well. And while we're not at 75, 80%, as you know, we're in a situation where 2/3 of stocks are actually trending bullishly. Which is showing that there's actually things working. And when you look at the equal weight index, because I know that you've on many occasions spoken about this topic, and I'd love you to kind of add to this. We're about to break to a fresh new high on the equal weight.
Yeah. Do you know what also is interesting, Patrick, about the equal weight? Pull up equal weight divided by S&P 500, like the standard one. Pull that chart up, and then have a look at the day it bottomed. And when you look at that, you'll see it's October 29th.
Okay.
Right? Or right around there.
Yeah.
And then on a separate chart, go look at the high on the NASDAQ. October 29th. Well, in essence, what's happened is the NASDAQ topped on October 29th. We have gone sideways for 3-4 months now. And the reality is that there's been all of these other stocks that have been rallying. Right. And one of the things, though, that we need to remember, and we talked about this lots of times, the Mag 7 is so large compared to everything else. As a little bit of money comes out of that,
2/3 of the NASDAQ.
Yeah. As a little bit of money has come out of that, it's rushed into the other ones, and it's moved those other ones so much and so quickly. Yeah. And you were the one last week or 2 weeks ago that highlighted XLP. And I was just like aghast when I saw the chart. I was like, if you're not paying attention, which I wasn't, you don't realize that the staples were just like flying. And this is what happens.
The theme now is that halos, right? Like the things that are more AI resilient, real resources and brick and mortar things that can't be easily have their business models kind of interrupted through the AI getting better and better. But that's the idea at this point is a sector rotation is when they're slamming the software, it's going into the cheap things. Like remember, like XLP, let's just go talk about this. It's a 52-week high. But if I go back and look at this thing back at the start of the year, it was one of the worst performers in the sectors. It was dog shit. Stocks like Procter and Gamble being murdered, PepsiCo down on its lows, Colgate, Clorox, General Mills. You can name any kind of consumer staple name. They were at 52-week lows, having their faces ripped off. I mean, only Walmart was able to buck the trend throughout this kind of massacre that was going on. Nobody wanted to touch these things with a 10-foot pole. And other than someone who would say, oh, that's a key bottom retest and a major support line, some technicians that are leaning into to support, it was very hard to convince yourself to put positions in here. But yet, look at that rip that's happened when the sector rotation really kicked in. They just took off. And like, as an example, I'm just going to pick on Colgate just for the sake of it, but like tell me that this was not the chart of death before the takeoff, right? Like, no, who wants toothpaste? Like, like you're just gonna like this is this is a chart that was like putting the nails in the coffin of the fact that this company was going out of business or something. I don't know, it's exaggerating, but like point is it got clipped by 30%. That's not chump change during a period when the stock market was being outright bullish.
And can I just highlight one thing about this? And you're spot on, correct, Patrick, in your analysis that it turned on a dime. And the reality was that it was difficult because if you missed it, it just took off and it didn't let you back in. And one of the things that I would just like to stress is that the positive, turned on a dime, but it can happen as well to the negative side. Mm-hmm. And people have completely and utterly forgotten about this. And one of these days we're going to get moves to the downside.
Are you already getting to bear porn this early?
I know,
we were going to work our way to the bear porn. And you're getting ahead of yourself. You get like everyone online is like getting frothed up.
13-year-old boy that just wants to see the pictures. Okay. I'm sorry. So yes, XLP is going higher. What else? Talk about the good things.
No, but like for instance, XLU, the utilities broke to fresh new highs. Clearly a very clean wedging retracement, got back above its 50-day at the start of at the end of January and really started to go. Obviously, huge sector rotation into energy. Energy has been strong since January. That's once the sector rotation started, people can't get enough of these energy stocks. Suddenly the Exxon Mobil's have become look at the parabolic rise of Exxon. When the hell was the last time you saw Exxon move like this? Yeah. It's absolutely crazy the money that's pounding into these stocks. The flows are just, there's not enough inventory available. They're just ripping it to the upside on a stock that used to be the largest company in the United States. Like if you go back to before the great financial crisis, this was the largest company in the United States. And you have a scenario where literally it's being squeezed. Right?
I don't know. You think it's being squeezed?
Well, not squeezed, okay, but it's ripping from demand,
flowing, the flows, or whatever.
Okay. Yeah, it's flowing. Anyway, but
I want to see where it is now. I'm just trying to pull it up. 1 second. Exxon 13th.
Yeah.
What do you think? Do you think it's going to be the biggest company again ever?
I don't know about that because some of these tech names will still be major leaders, but will energy as a basket become 10% weighting of the S&P again? I think so. There was a point where where energy was like a 16% weighting in the S&P 500, wasn't it? Something like that?
I don't know. I'm just pulling up because I wrote a piece about that. So the percent of the index here are 3,000. So I don't know in the S&P 500, but I know in the Russell 3000, which is the big index, I can see that it was 12% and it's down to 3. So yeah.
So I remember seeing a 15-16% number on the S&P 500 before during that heyday when Exxon was the largest company. Now, can we see us go back to 10%? I think so. Does that mean that Exxon has to be the largest company? No, but I do think that sector rotation can continue over the next decade, and I think that a lot of these companies can continue to do very well. Obviously.
1 second, Patrick. I just wanted to jump in here. I did find my chart. In 2000, it was 4.5% of the U.S. index or the S&P 500, and so that's in 2000, 4.5%. It went to 16, and it's now under 3. So your call is 10?
I'm just saying, like, it doesn't, I'm not making the call that Exxon will be the largest company again.
No.
But I do think the S&P
yeah.
in the energy sector could easily be a 10% weighting again.
Yeah, I think that's a fair call.
Right? Like there's so much opportunity. Like when you take something like the OIH, which is these oil service names, it's been a phenomenal run. Right. But when I go and look at this on a monthly chart, right, it's been a decade of death. Right. Like the oil service stocks have gone from 1,500 down to 100. Right. Like, I mean, I'm not sure what the behind the scenes thing of why this happened so severely, but that's a 95% peak to trough on this ETF. Right. And we only on the monthly charts began a legitimate breakout off of a key bottom retest. Like this is 2 months into what is the first time that this thing has turned around and got above its 50-month moving average.
And so for those who don't know, I recorded Trader Ferg earlier this morning, and Patrick has not heard it yet. But that is Trader Ferg's big call. Oil services, it's his biggest position.
Okay.
Well, there you go.
Well, I do like Trader Ferg. He's clearly a very intelligent man. This is solid. Anyway, so these sectors are all benefactors. Obviously, things like defense contractors, particularly the European defense contractors, continue to take flows. They're basically, these are the kind of areas where a lot, and even though it's not moved strongly, the healthcare's XLV still is super strong after an epic run. I nailed that bottom perfectly back in the summer. Just to toot my own horn here for a moment, you laugh it up.
This is what happens when you move out of Canada. Next thing I know, you start bragging about shit.
Okay, I got lucky. Sometimes,
okay, that's a more
shit
Canadian
happens,
thing.
right? Like, it's a little bit of luck helps. No, but the key here is that this is a pattern technicians often refer to as an ascending triangle, making higher lows. Basically, all of the supply is being soaked up. And if this thing breaks to 52 weeks highs right here, it might be right off to the races again. And finally, while your Eli Lilly's, like, look at the way Johnson & Johnson, like Johnson & Johnson's been, like, I can't believe I missed this. I'm looking at this chart and it's like, this is epic, right? Like the Johnson & Johnson doubled since the summer. Insane. But there's the laggards, and the laggards are, like, for instance, Pfizer. And you can see Pfizer, which has been dogging it. Let me just look at the thing, is just starting to get going. And so, like, you might have a scenario where like, again, these sector rotation story may not be over, and these things that as they flows out, there's plenty of value out there where money will go and redistribute from the Mag 7s into a lot of these things. And I don't think it's over.
Okay.
All right.
Keep going. What else we got?
No. So that's all I got for bullishness.
Okay.
I've got nothing else. Well, at least no, I've got other things, but from a stock market perspective, that's one thing. But so let's start by looking at the Nasdaq. And the Nasdaq is got a very interesting pattern. Many technicians will love to point out a very explicit double top, right? And what's particularly interesting about the sell-off that we saw was that not only did it not hold a Fibonacci zone, it pretty much came a stone throw away from retesting the November low. But this entire rally over the last month has been nothing short of a pathetic flagging formation that has failed to hold the 50-day moving average on any attempt. And if NVIDIA, which we'll get to right now, it has in fact been a sell-on news event, then you have to ask yourself, is the NASDAQ's topping formation legit? And will we inevitably get the break of this neckline that from a technical analysis perspective solidifies this as a topping formation and puts in motion a bear market decline in this index at least? And so, it looks pretty ugly from a chart. What collaborates this? What collaborates this for sure is the Mag 7 ETF. Not only did it fail to do a double top retest of its previous highs, but what do you want to call this? A rounding top, dumpling top, whatever top you want.
A dumpling top?
A dumpling top. That's like a Japanese
that's like
candlestick.
I don't. I have too much weight up top.
Absolutely, exactly. Like you
top.
put like a dumpling top at the anyway. But or whether you want to jam a head and shoulders topping formation on there, like to the eye of the beholder. Of technicians always see what they want to see in these types of patterns. The thing here is it's distributive in its nature. And we started making lower highs and lower lows. And what was particularly the nail in the coffin for me is this rally was pathetic. It was pathetic. Like the S&P 500 managed to make it back to almost 7,000 during that window, a legitimate retracement. There's things that are moving. And this bounce on the Mag 7 ETF is incredibly weak on a relative basis to the other moves out there. And this, obviously, I know you've written your pieces about it because you're dead right. The Mag 7s are where the selling has been. You called it really well, Kev. And really, I don't see any reason why this thesis is interrupted. And the one that just may have put the nails in the coffin is NVIDIA. And let's talk about this. To me, the one thing that I was talking with my members is that it doesn't actually matter whether NVIDIA actually beats on its numbers. What matters is how traders react after they beat. Yeah. And what we saw was they came out with a explicit beat on revenues, explicit beat on earnings, everything that should have been bull porn for the next gap higher to take the semiconductors to the next level. And it not only didn't gap higher in the after hours, but the moment that market opened at 9:30, they leaned into the selling immediately. Like it did not even wait until 9:31. Like the moment 9:30 hit, it was red. And the selling hasn't stopped. It didn't stop at the 50-day moving average. It didn't stop at the hourly Fibonacci zone. Like we have not broken a major support line, but there is a buyer strike. And if an earnings beat like that is not going to drive buyers in to start the next bull cycle, what's next? And the only thing that I could think of is that there's going to be some further profit taking. And if NVIDIA here stays below the 50-day moving average, it's only going to drag that Mag 7. And it really is going to exacerbate this sector rotation story. But the one thing that I wanted to ask you right now, sector rotation is the name of the game for the last 2 months. And those that have been sector rotating preemptively have been very well rewarded for having made their move, or, a couple months earlier, and have participated, have a great start to the year. Everything is good. If the S&P 5, if this breakdown in the mags drives the S&P 500, I don't know whether you have an update as to where it is, but as far as I'm aware from all the quants that we follow, that 6,800 is more or less where a lot of the systematic tripwires lie for where the flows will pivot and deleveraging really kicks in. But if we get to a stage where systematic traders are actually now hammering the index, because that's what they're predominantly positioned in, do you think sector rotation will prevail, or could we see that once systematic traders get in there, that it becomes a correlation one thing, where suddenly nothing is safe?
I don't even think it needs to be correlation one thing, Patrick, because correlation is so low, and record low in terms of amongst the index. So all we need is an uptick in correlation, and I think the index will start moving together. And if the index moves together, then all of a sudden volatility increases, and if volatility increases, then we have a situation where the option market makers have to sell deltas because of their Vanna exposure. It wouldn't take very much, in my opinion, for these things to start trading together more, and in that in itself being a negative outcome. So I don't know if you need to have something as dramatic as a move to an extreme correlation one or towards that. I think just any uptick at all is going to be negative, and then it's going to feed on itself.
The what I'm thinking as a plausible, like I have no evidence, nor is it a forecast, but all of these consumer staples, all of these energy names are so bullishly overextended that if we do have a sell-off, the epicenter of the selling is going to remain the same, which is going to be the further software deterioration, Mag 7 deterioration, maybe semiconductors ultimately join the party. We may see the Kospi turnaround. All these different things will be the epicenters where there's going to be the extreme volatility. But maybe this is where we see mean reversion on these big impulses on these consumer staples and other things, where we see 50% retracements, where everything takes a breather and consolidates, as money is actually being margin called, and people are raising capital in a liquidity crunch rather than just sector rotating. Sector rotating is very much when things are orderly and fine, but when margin calls are happening, then people sell what they can, and they just start fucking hammering whatever is available, right?
I don't even know if it needs to be that dramatic, Patrick. But like, all you need is an asset allocation shift. And I hate to say this, but what if bonds get a bid? What if folks go and say,
you're ruining my next part?
Okay, but that's all it'll take, is folks getting a little worried about the economy, saying that there's too much enthusiasm built in. And I know all the positives about why Trump's not going to let the economy go down. We're getting rebate checks, yada, yada, yada. Like, I get it. But the expectations for a strong economy are so high that to me, if we actually got rolling over even in the slightest, it would cause investors to have to shift out of stocks into bonds. And to your point, what if they start selling Mag 7, but instead of that money going into the staples of the world, they actually go into bonds? And then all of a sudden, the staples aren't bid anymore, and they correct, and it all kind of just feeds upon.
Well, a lot of the high dividend payers have that bond proxy kind of
I guess
tailwind.
so, but the reality is that they've gone up without the bonds now, so it doesn't. A lot of those relationships are gone.
I don't hate your idea. And me and David Rosenberg are sitting there just getting super excited about what you just said. The greatest bond bear out there is giving us a.
I'm just saying that for
me
the
and
first
Lacey Hunt and David Rosenberg are going to give you
for
a
the
big
first
hug.
time.
Welcome aboard. All right. So
by the way, you've missed the really important part. Did you know that we've had some Hindenburg omen chart triggers? And not only that, I'm going to go to my chat here because my guys are all over this. It's there's some sort of window for the stars. Do you know about this?
I do not know about the star, but I do know now that I'm going to have to find it. But on TradingView, they have the moon cycles as an indicator. So that way, just in case those people that thought that technical analysis was just a little wonky,
they can go onto
add
the
moon cycles right into this chart. And then we're going to be able to measure these cycles.
Yeah, there's a whole thing that's happening. So we were talking about this. It's going to be the Great Hindenburg Putz crash because this Putz is, I don't know, there's something where all the stars and stuff have aligned. But then I found out that it's also a worm moon at on March 3rd. So if we do get a crash, it'll have to be called the Hindenburg Putz worm moon crash of 2026. But then one of my folks guys, he actually come up with it. It could be the Putzenberg crash of 2026 if it occurs. So that's Thomas came up with that. So if we actually get a decent sell-off, it'll be
a Putzenberg.
A Putzenberg.
There you go. Everyone heard it on the huddle, even though it's not originally made by the huddle. You heard it on the huddle first.
Right, exactly. Be careful. It's a worm moon, and like the everything's like all lining up in the stars. And
you're making me nervous.
Obviously, we're kidding. I have no clue.
We already pivoted to the bear porn. This is insane.
Yeah, well, there we go. It doesn't get any better than naming like celestial setups. Yeah. So you know you're desperate when that's happening.
So
one second before you do that. The other thing you got to be worried about is when chart traders start talking about weather. So like if someone says. So if Patrick and I get on here, we go, listen, we're really bullish nat gas. I heard that there's like some weather thing happening. You should be just fading that all day long. Like that's just any weather or moon cycles sold. So there's no way we're going to crash.
There you go. So I want to though step back and look at the S&P 500 on the monthly charts.
Okay.
Like this is like, we're looking at the last couple decades here. And what you can observe is that the entire Liberation Day sell-off wasn't really a bear market. It was pretty much a 50% retracement of the prior bull advance that basically tested the 50-month moving average. Like in the end, it was simply a pause in the resumption of the bull phase. What a lot of what has to one think about is that are we though talking about just the long-awaited market correction since we've had this huge bull run off of the Liberation Day low, or is it a much more prolonged bear market? I, to be honest, think that the structural changes that inevitably arise from AI could ultimately lead to a correction, but it's kind of bold to make a call that this is the moment. To me, we could be still running a bull phase into 2028. This idea that here in early 2026 is the moment where the big kahuna begins. But when you look at a monthly chart, there's some sort of a correction coming. Obviously, that could come from stresses in financials. It could come from the Mag 7s in a huge liquidation cycle, mean reversion on all of that. But are you just looking for a correction at this point, or do you think there's something bigger?
It's something bigger is coming. We're like everyone's convinced that the business cycle or the economic cycle is dead, and that there's no way Trump is going to let the economy go down. And I'll say it again, like the idea that
I can't believe you're more bearish than me. I'm the bear in the group.
like the idea
Like you
that
can't.
I know, I hear you that it is kind of worrisome.
No. I'm just saying, like I'm proud of you, Cash. Like,
I'm proud of you. Thanks, Dad. Yeah, listen, I just look at the risk reward, and the risk reward,
it's awful.
And to me, it's when everyone starts telling me that the economy can't go down and that there's no signs of it. And since when does anyone ever called a recession correctly? Like when has a recession ever been forecasted? Right? Like I go back and look at the 2000 and I think it was 6 or 7. It was the strategist, and they were forecasting what they thought for the S&P 500, and it was hilarious. Like Tom Lee with his usual, like up 25% call, and the S&P ended up down 35 or whatever it was. The point is that crises or recessions or market declines of significant nature are always surprises. And for me,
there is one commonality from a monetary cycle perspective, is that usually the Fed tightens too much too quickly, or not too quickly, but tightens, and at the end of a tightening cycle, they stay tight too long, and over a year or so that follow that period, recessions tend to appear. At least in the previous monetary cycles, this has happened, and we have gone through a monetary tightening cycle, and we remain at elevated interest rate levels, and we are several years off of it. So, I mean, to me, that does line up.
Okay, I'll just give you my take on this. You are correct that from 1982 all the way to 2020, the reality is that business cycles were dramatically, the thing that affected them most was the setting of interest rates. That was what dealt it, because that was the only lever that usually governments or central bankers used to try to affect the economy. So that was what happened. 2020, once COVID came, it changed the equation. We threw fiscal in there. So now the problem is that we have two different forces. We have the monetary tightening that we experienced from 2022 or 2021 to 2023 or whatever it was. And that was also, fighting against the monetary stimulus that we've experienced. And now the problem is that we understand fiscal stimulus, and the market is kind of pricing that in. So to one extent, I think that it's become more efficient in that you no longer have to convince people that a deficit actually causes the economy to do well. Because Patrick, don't forget 2020, when I was on Macro Voices with you and we were saying that they were going to have deficits, I got told that was going to send stocks down, that was going to cause problems in the economy because it was going to create a financial crisis. So now we've gone the other way. We all think that the government can just keep spending and spending and spending, and it's going to, send the economy, the stock market to the moon. And then the other thing is that I think that we're, missing the part. Everyone focuses on the stimulus of the one big beautiful bill, and they forget about the negative of tariffs. And they don't look at that. And then it just all of these, and the other part is that we're just so focused on fiscal, people forget about monetary, and monetary runs, at a, with a lag. And so to a certain extent, I'm kind of with you. I just think that we've messed up all the timing in terms of by having so much fiscal stimulus in it. We've kind of tricked ourselves into this, but the reality is that we did a whole lot of tightening. And now in terms of a monetary level, and to believe that that's not going to slow the economy eventually is like, I think it's naive. Like, I think it's eventually going to slow the economy. And then also, I think that the fiscal is vastly overstated in terms of like how stimulative it actually is. Anyways, rant over.
All right. Rant over. Let's get back to the charts.
Okay. Yeah.
But listen, no, honestly, you didn't say anything I disagree with. And you actually were the one of the first people that I heard talk about that in there. Obviously, there's a lot of people in that camp now because they clearly read your newsletter and it spreads quickly. But in the end, I don't.
It's like an STD at St. Bart's. Okay,
Exactly.
let's go on.
Okay, so I want to talk about the Kospi. And to me, while everyone stares at NVIDIA, while everyone wants to look at Tesla, while everyone wants to look at this chart and that chart, I actually think that this chart represents the epicenter of the AI bubble. And when this thing actually reverses, this is going to be the actual start of the sell-off. The part that makes it imminent, and whatever Hindenburg, or what did you call it?
the Putzenberg. I can't
Putzenberg.
remember.
So in spite of the Putzenberg, this chart actually I think lines up better than any star alignment.
No. Listen, you got it backwards. The worm moon during the Putzenberg window will actually send the Kospi down. You got it backwards.
Enough.
But anyways, okay.
I got it backwards.
Okay, yeah.
But what I want to highlight is that what is not backwards is one of the things me and you love doing on this is I love to show this acceleration of slope in the bubble phases. We did this on gold and silver just a couple months ago, and we're doing it again. But we are now literally entering the actual steepest parabolic phase of the Kospi advance. And the one thing that I always say to my members all the time, which is the one thing that's the hardest thing to predict, is what the ultimate price level will end up being of a bubble. Because when things go to these blow off tops, could it be 6,600? Could it be 7,000? You don't know. And more importantly, it could be at 7,000 in 2 days, right? Like when you're in the final parabolic phase, things get ridiculous. But the one thing, I'm going to make a call on this show right now.
Yeah.
I give it a very high probability. I'm just going to stick my neck out. The next time we record the market huddle in 2 weeks, a swing high will be put in some sort of correction is underway in the Kospi. Because the one part that is most predictable about parabolic rises is time. And the time is compressed. Things happen so fast. Just look at the way, for instance, the peak on silver came, right? Like it blew off, it accelerated into the final thing. And literally within a week, the thing blew off the top and had the sell-off. In the same way, I think we're witnessing the exact same thing on the Kospi.
Well, I'll go even farther than you are. I will say that a week from now or 2 weeks from now, it'll be down 10% from here.
Oh, you're stealing the call from me and doubling down. Okay.
It's good. There was a mopey call. You have to be more aggressive.
All right. Point is, when this peaks and reverses, it's over for the NASDAQ.
Yeah. Okay, so that is some good value add there. So your argument, and I'm not disagreeing, but I haven't really thought about it, is that will be the moment that the NASDAQ breaks that lower thing and takes
because this is now the AI bubble. This is where shit's happening, and when this bursts, it will trickle in through everything else.
So that is a good call, and I'm going to leave that to you, and I'm going to say that was all you, and that's your call, and I like it.
Okay. So the second thing I want to talk about is this little tiny prairie dog on the semiconductors that everyone teased right before the NVIDIA's earnings. If that little prairie dog, which is a fake,
a noble animal. You always have to say that when you say prairie
it's a noble animal.
Yeah.
But if all of these stars align, Kospi puts in its top, semiconductors, this was a prairie dog, NASDAQ fails its thing, Mag 7s can't get above its 50-day moving average, and suddenly the Putzenberg happens. Shit's gonna hit the fan. Telling you, it's gonna be insane.
Dogs and cats living together. Listen, I missed this prairie dog. That's a beautiful looking prairie dog.
Yeah.
Like that's perfect. Textbook.
Textbook prairie dog.
Yeah.
Fakes everyone out with a 52-week high right before NVIDIA's earnings. They beat in a big way and they pull the rug out from underneath them.
Oh man, I missed it. More value add from Patrick.
There you go. So, but anyway, and what is interesting is that there was a big rotation out of software. We never put that. Here's quickly a software chart. And so this was the messing around of the tech software ETF, the IGV, which the SaaS kind of stocks that were in that bloodbath. And by the way, that was a classic, what's it called, turtle head formation, like the reverse happening almost to the day, where just
Did it
poked
really?
its head out.
Like, was it the same day?
No.
Okay.
No.
That's close though.
But it gave the clean drop on the Monday.
Yeah.
And said, no, thank you. I'm sliding right back into the trade range. Boop. Right.
What do you think about? I think I did I talk about it here? No, I must have talked about my chat. I was taking shots at short semis, long software.
You can. I just think that you avoid this space. Like, look, can software do a 50% retrace or 30% retrace back to its 50-day moving average and tap the 90 and give you a quick 10% rise? Sure, but you're being a rock star in a primary bear market on something that's being murdered, and you're trying to fade an oversold condition. All I'm saying is I would have that 1 foot out the exit door, and if it's not working, it'd be the first thing I would exit it super fast. Like, if you're trying to catch a little oversold bounce, have fun playing your little games, but this is not investable. This is not investable. You can't go and take a long-term position on this here.
Yeah, no, I'm not taking long-term. It was purely a trade.
Like, maybe you could cherry pick something like Microsoft because it's actually got a moat around its business a little bit more. And so, like, you can try to cherry pick an individual software name. But this thing here has dog shit like Duolingo and Adobe and other shit like that in there, Salesforce, other stuff that is is just not structurally going to go into a bull market phase at any point. Right. Like, and so it's anyway, point though, just going back into this is that all of these tech names are a thing. But the one thing I want to just say before, now that we've unloaded on all this bear porn, I still feel that when you stay invested into resources, like, look at the way things are running on so many of the resource names, everything from iron ore names, the lithium names, the aluminum names, your Alcoas, like, everything is holding up really, really well. There is money flowing into resources, into energy, into consumer staples. Now, while they all will take a breather if the whole stock market trips up, but those bull markets in those areas are not over. And those are just areas that should be bought on dip instantaneously. If a liquidity trip up happens and those things, get shaved 10 to 20% in a quick market correction because these tech names are getting slammed, I would be just loading up on them. There are places to be bullish. I think you have to just stay with these things that are going to be bullish and avoid these areas that are highly fragile.
Yeah, I don't disagree. And one of the things I would recommend to folks is imagine that changes tomorrow and the market gets ugly. What are you going to want to buy? Get ready with your buy list, and don't, once it's occurring, it's going to be tough. Like, what's the Walter Deemer line? When the time comes to sell, you won't want to. And then what's the other line? When the time comes to buy, you won't want to do that either. Yeah. So pick your levels now, get yourself, your list, and say, okay, if I get GDX at this price, if I get Alcoa at this price.
The temptation for muscle memory is that the Mag 7s have been so spectacular for the last decade that when you have a chance to buy some of these Mags 30% off their highs, the instinct will be to buy them. Then maybe you can get a reaction.
Yeah. But, and Patrick, to that point, and actually, I'm glad you schooled me on IGV because I had a good buddy that's a big broker, and he told me that he's getting like inbound calls from his clients saying, let's buy Microsoft, let's buy all these things. They're trying to buy all these things that are down, and it's not because they actually know the business, it's just because they're down.
Yeah, and the muscle memory of the big leaders.
And you're right. And when these things roll over, that is what happens. And people, just buy something because it's down. Yeah. And as we saw, as a whole nation of Canadians, how many people bought Nortel the whole way down because it was down X percent, right? Right. Like, what's that line? What's the easiest way for something to be down 95%? For it to be down 90 and then go down 50% again. Like, it's like the reality is that's what occurs. So you're right. Pick the winners. Don't be buying these things. And me, after years of
we're in a new regime where real assets are actually what are actually investable at this moment. And so you got to stay in the bull markets that are secular at this stage. And that's where I think we should encourage our listeners to look at. So listen, we have only, I want to keep this to 10 more minutes. So let's quickly just go through a couple of things. Let's just because you can poke at you with a little bit of SOFR shit, a little stir trader.
Oh yeah. Well, you are a new stir trader, so you can't avoid this.
Quickly, PPI comes in hot.
Yeah.
But yet SOFR futures pop. I'm confused. Can you explain?
Yeah, I think that everyone's worried about unemployment. And let's face it, the reality is that if unemployment starts going up in a big way, the Fed's going to cut
today's
rates.
Reaction,
I think, has more to do with like the worries in the marketplace that we are going to see unemployment going up because of AI. Now we can debate
is overbearing to the fact that we had a hot inflation number.
Yeah, listen. Okay. If we get a situation where unemployment starts going up in a big way, they're going to cut rates. Forget about it.
So what I've been obsessed about staring at the December 2026 contract.
Okay.
But what has been clear though is the messaging from Powell is things are going to, and at least the way it continues to be priced into Fed funds futures is that we're inactive until the summer, and that it's going to be Warsh's problem. And Powell is basically taking the knee unless situation can always evolve very quickly. And in a future meeting, things reprice. But as of this moment, their market is favoring the scenario that nothing happens until we have a changing of the guard at the Fed. So the thing that when I look at this December contract, we're really only looking at Fed policy for the back half of the year, which does not allow a lot of rate cuts to be priced in just from time frame. 6 months, there's only so many things that are going to happen in 6 months.
Well,
and so let me just finish my point, and then then you can shit on it.
Okay. No, I'm the one to shit on it.
But the one thing though is that this is where I wanted to move to the 2027 December, which is now something closer to 2 years in duration, much closer to a 2-year treasury, and much more reflective of if things really do deteriorate, what will truly capture the window from which a rate cut cycle would actually happen. And what we saw was a 50 basis point move on the December 2027s. And the question is, should we just stop tracking the 2026s and focus on the 2027 for Fed path kind of analysis? Because we could potentially now be breaking the 3% level, which is where we saw the resistance come in from previous. The potential rate hikes at the end of 2020 have been pulled completely out. And if this thing is going to be a scenario where the Fed may have to be far more dovish, this is the one that probably has the potential to see 98 or higher if there was a serious dovish pivot. So am I in line to say that I stop focusing on the 2026 and start making the 2027 December contract my focal point?
Well, first of all, you don't need to trade Decembers, right? Like there's other months.
Yeah, of course. But I like to think of it as a year.
Okay.
So like I'm looking at like what's the.
So you are correct about the market is increasingly expecting the Fed to be on hold, even in the face of weak unemployment numbers. One of the things, though, I would say to you is that they're now slightly different bets. So your 2026 would work in the following scenario. Let's imagine the economy started rolling over, but inflation stayed bid enough that the Fed chose to be more hawkish than they should be. If they let politics get in the way of doing what's right, we would then have a situation where the economy would be slowing more than expected because the Fed would be overly tight at the front end. And what could occur is that could then lead for a real economic problem or a real market problem. And then it ends up being that they don't cut. And then they have to cut a lot because something happens. So that is increasingly what you're playing for with 2026, I would say.
Yeah.
That's your real bullish on the December 2026 contract. Now, if you just think the economy is going to roll over and that they're going to work their way, towards lower rates with the new Fed chair, and it's going to be just a series of 50s, then yeah, you should move to 2028. Again, though, you have to look at 2027. You have to look at what's priced in, because now one of the problems is the 2027s are running ahead. So you're going to need a certain amount of cuts just to make money. Because you're buying a contract that has implicitly a certain amount of cuts in there. And the reality is that you're betting when you go long that the cuts are going to be even more than what's implied in the rate. So you're trading forward expectations about the policy. So one of the things about the 2026 that I think is nice is that if everyone expects them not to cut because of politics, and then they do that, yet then it causes real economic problems. Yeah. We could then be surprised. We get the surprise, 100 basis point cut. But listen, if that happens, your 2027s work too. So maybe you just go and trade the 2027s. No doubt about it.
Yeah. And they're both at 3% more or less. So your sort of starting line, it's not like the 2027s have baked in an additional 50 basis points, making, there be some incentive to move forward in the curve if you think it's going to be accelerated. At this stage, it's almost like you're starting at the same starting line for both of them. Anyway, let's talk about this long dated treasury, the 30-year, back to the point that you were trying to make earlier. I just want to add to some technical color quickly on it. We went through a vicious bear market. It may be one of the best calls you made in your career. No, you were bearish. You nailed it. You were just 3 years early. But you were spectacularly right. You were spectacularly right. And it was vicious, and it was literally one of the worst bond market bear markets in a century.
History. Yeah.
In history, century, whatever, a long time.
Yeah.
And but we have gone through now almost more than 2 full years in an incredibly tight trade range at a moment when bond implied volatilities on this are at their year lows. No one cares. No one's paying attention. No one's positioning. And both me and you are always big fans of getting into things when the price action's changing and nobody else gives a shit.
Yeah.
And it's cheap and there's convexity and there's asymmetry and there's everything in there and no one gives a shit. And that's, to me, what I like about it is that if I'm dead wrong about this bond trade, I'm not going to lose much. And there's so much room for it to surprise. And so that asymmetry makes the trade so easy to put on here. Anything you want to add to that?
No, I'm going to just keep my mouth shut. I won't disagree. Okay. I can't get myself to buy the long end, but I definitely would have trouble being just short long end. Like I understand all the arguments, and to me, I agree with you. Like, there is a chance that it surprises. Like, if you had to choose up or down from here, what would surprise the market more? Up in terms of price, down.
Well, you know what? overall, the first reaction, the first impact of AI has to be a deflationary impulse from it. Inevitably, it will lead to a reaction function of fiscal and monetary that could have all sorts of monetary inflationary things that will have lots of trouble for this bond down the future. But the first reaction should be a disinflationary one until it drives the reaction function. And to me, that gives that surprise upside potential.
Yeah, I'm not going to argue. Okay, anything else, or should we call
Just
it
quickly,
a day?
we can't not mention gold and silver and
Okay.
oil. And that's it, right? Just quickly, gold. What's I'm going to put it back here on a daily chart, working its way back to its highs. I'm still torn because in the past, every time gold has had a blow off, it's taken 2 to 4 months of sideways consolidation before it breaks the 52-week highs and goes again. And so if that playbook stays, because it's been a pattern that we have seen repeatedly in gold, then we could still see a short-term high, grinds out till April, and then it will be more in the late second quarter, if not a second half of the year story where gold goes higher. That at least has precedent to it. But yet gold is being well accumulated here. And I'm torn because on one side, I see that it's like it was bought on dip, and every day the freaking thing is up and it's being accumulated. But there's a lot of reason to believe that the price needs to absorb and spend some time basing before it rises. And I'm torn because for me, I don't want to get in so early where I'm going to get chewed up for 2 months as this thing gets trade ranged a bit more and gets chewed up before it resumes. What's your thoughts?
I have no thoughts. I think there's easier trades out there than gold right now.
Okay.
So that's how I kind of feel.
And silver just, by the way, made a 50% retrace. So we've finally seen that correction get back into the retracement zone. So a lot of important things are going to be revealed here in this window. Last thing, oil attempted to make another multi-month high, gave a little bit back here. Obviously, geopolitics it's going to be headline porn in terms of like what happens in the Middle East and stuff like this. Like, I understand that there's a fundamental reason why oil should, strengthen throughout the year, but really we are now in a situation where the risk premium and everyone's attention to play the bets on the outcomes of the war, or whether a war or missile strikes or anything happen, means that I think oil is very vulnerable to $5 swings higher or lower in very short windows of time. That has nothing to do with the long-term bull thesis. And it's going to be messy. We're going into a weekend here. What are your thoughts here on the short term? And obviously, I think long-term, you're already bullish, right?
Well, I think that I agree that there is some more premium in there. I don't think it's as much as everyone thinks, and I still contend that maybe there's $5 of downside, and in the event that there's some sort of deal, and there's $20 of upside in terms of like a real problem. So I still think it's skewed towards positive. You should own oil, and to me, it's like maybe I don't know the right numbers, but let's say it's 1/3 a chance of a deal, 2/3 a chance that there's some event that occurs. So at that point, the math just says you should be long.
There you go. Love it.
That's
all I've got.
Okay, that's it. It's been a long one.
Let's make this a wrap.
Okay. All right, folks. Thank you for tuning in. It's always great to have everyone, spend this long with us. Patrick, where can they find more about you and your terrific company and all the stuff you guys offer?
Trading.com. You can try a 14-day free trial. You can check me out on my YouTube channel at Patrick_Ceresna, where I do a very quick 10-minute macro outlook every morning at 9:30 a.m., Monday through Thursday, completely free. And get my little insights every morning on that little live stream that happens on YouTube. So check it out. Kev, you wrote a great newsletter piece that I didn't get to. It's in my inbox. I literally have it flagged. And I apologize for not having read it beforehand because I'm giving Bespoke the call out when you did.
No, it is Bespoke's. It is Bespoke's actual numbers, and it was part of my inspiration. Yeah, okay. was George's George. He's a great guy, and that was a great chart. And I actually just took the whole chart for it because it was just so well done.
And you just ran with it. But listen, you write a great letter. Where can people find it?
They go to macrotourist.com. Listen, bull market, bear market, we're just happy for you guys to spend some time on this crazy ride. Now stick around for the after show. So, Patrick, are you in Toronto, bud?
No, I'm back. This is my studio. See this thing? I'm back.
Then why do you have a Toronto beer?
I still have a few of these stragglers that we couldn't
it's
match.
a straggler. Okay.
Like I still have a few more stragglers where people brought me some beers to feature, but we didn't have them to match up. But I'm back in Toronto in a couple of weeks, so me and you are going to have to do some beer exchange.
Some beer exchanges and pissing up. Okay, give
Absolutely.
us the rating of this beer.
Yes, it's a great beer. It's actually a good beer. Now it's a light drinking lager.
Yeah.
And so, it's like one of these things where if it was a summer day and you're outside in the sun, like this is a banger. This is like,
okay. Give us a number, buddy.
I'm giving it 8.7 for lagers.
Oh gosh. Wow.
No,
That's really well
it's
done.
that good. I would buy a 2-4 of this.
Oh, that's awesome.
And throw it in the fridge. It's actually a great drinker.
So listen, I'm going to call it an early day here because I got to go. I want to eat some dinner or lunch, and I want to go and try to trade the rest of the afternoon. So everyone, be careful, be safe out there. Trade smaller. Remember, vol's going up. See you guys later. Take care.
Cheers, everyone.